Imagine you're running a lemonade stand. You buy lemons, sugar, and cups. These are your costs. You sell glasses of lemonade. This is your income. A profit and loss statement, often called a P&L, is like a report card for your business. It shows how much money you made or revenue and how much you spent or expenses over a specific time. It tells you if you made a profit, meaning you earned more than you spent, or a loss, which means you spent more than you earned. A P&L is crucial for any business owner. It helps you understand your business's financial health. It guides you in making informed decisions about pricing, expenses, and investments. Whether you're a seasoned entrepreneur or just starting, understanding your P&L is essential for success. Let's break down the key components of a P&L: revenue, expenses, and net income. Revenue is the money your business generates from selling its products or services. For your lemonade stand, it's the money you make from selling lemonade. Expenses are the costs incurred to generate that revenue. These include the cost of lemons, sugar, cups, and maybe even a sign. Net income is the bottom line. It's the profit or loss your business made. You calculate it by subtracting total expenses from total revenue. If your revenue is higher than your expenses, you have a net profit. If your expenses exceed your revenue, you have a net loss. A typical P&L statement is divided into two main sections: revenue and expenses. The revenue section usually starts with sales or revenue. It lists all sources of income for your business. This could include sales of goods, services, or any other income streams. The expenses section details all the costs associated with running your business. These are often categorized as cost of goods sold, COGS, operating expenses, and non-operating expenses. COGS are directly related to producing your product, like the lemons and sugar for your lemonade. Operating expenses include rent, salaries, and marketing costs. Non-operating expenses are costs not directly tied to your core business operations, like interest payments. Understanding your P&L statement is crucial for making informed business decisions. It helps you identify areas where you're doing well and areas that need improvement. For example, a high COGS might indicate that you need to find cheaper suppliers or adjust your pricing. A large marketing expense with little revenue growth might suggest that your marketing strategies need refining. By analyzing your P&L, you can make strategic decisions about your business. You can identify trends, anticipate future performance, and make proactive adjustments to ensure profitability and growth. Remember, a P&L statement is more than just numbers. It's a powerful tool for understanding and managing your business's financial health.